Hello, my name is James Neathery. Welcome to the Banking with Life Q&A series. This is where I answer questions that you have concerning the infinite banking concept. So let's get started. In this question, do you guys have mortgages on your primary homes or a first lien HELOC? No, don't have a HELOC, first position, second position. I personally have a 30-year mortgage. Thanks, James and Ron, for another great podcast. Thank you for saying that. Here's a question I'm sure you've answered before. If you take out a loan, how do you pay it back? Systematically, on purpose, with intent. And it's a compound question, right? Is it through premiums, and then is it limited because of the MEC, or can you pay back as much as you want? Okay, whenever you're making a loan repayment and you're paying additional interest, one or two things is going to happen. You're either going to pay down that loan faster. So if I'm borrowing money from the life insurance company at 5% as an example, and I'm repaying at 10%, I'm either going to pay that loan down faster than I would have otherwise because I'm paying additional interest. Well, I'm calling it additional interest. When the company receives anything above their stated loan rate, that is premium to the company. All right. So if I'm putting additional interest into my policy, that is premium. And yes, premium is affected by the MEC limit, or I can only pay a limited amount of premium on an annual basis before I exceed the MEC, the modified endowment contract. So I'm either going to pay down the loan faster, or I'm going to add additional premium to my policy. That additional premium is limited by the modified endowment contract limit. And then what is the best way to go about paying a loan back? Systematically, on purpose, with intent. I'm in control of the loan and the loan repayment. I'm either going to pay systematic monthly payments, whether I'm sending them a paper check or they're automatically drafting a checking or savings account, and I may have a particular loan on a monthly loan repayment schedule, or there could be a loan situation where there is no cash flows, right? There could be, maybe I make a loan and I make an investment and it doesn't produce immediate cash flows, but it'll create cash flows in the future. Well, then I'm either going to repay the loan, or I'm going to pay interest on the loan, or I'm going to wait till that particular investment has a cash flow. Does that make sense? I hope so. Can you do other investment recommendations and how to use the infinite banking concept with them? The short answer is yes. I am an investment advisor representative, and I don't give investment advice unless we've engaged. I only give investment advice to my clients, our clients. And yes, I know how to integrate the infinite banking concept into everything that you're doing or that is being done. All right, this question: do policy loans get reported to the credit bureaus? No, they do not. That is a private transaction, and it's just exercising a contractual right that you have. You have cash value. You have a contractual right to withdraw that or borrow against it, request a loan. That's a private transaction between you and the life insurance company. So no, it is not reported. In this question, did you make a video explaining the premiums and PUA and why it takes a few years of losing money up front? Okay, well, let me address that. And I think we've talked about that in several podcasts, but you're not losing money. There is a loss of liquidity for a time period. So if I pay a premium, and if I paid in $10,000, I only have access to $6,000, $7,000, or $8,000, whatever it is in the first year, and I quit, that is a loss. There's no question. If I continue that policy and I continue making premium payments, there's some point in time in the future that my total cumulative premium payments in is going to equal and then exceed the total cumulative cash value. So there is a loss of liquidity in the early years of a life insurance policy. He goes on in that question with this statement, because every now and then I get hesitant paying the PUA. Well, and I think that's completely natural. If you buy a life insurance policy, it comes with a premium. The premium looks like an obligation, and it is. Part of it is an obligation. However, all of the liquidity in a life insurance policy in the early years is into the PUA, the paid up additions rider. So remember Nelson's 4 fundamental rules. Number 1, think long range. Number 2, don't be afraid to capitalize, i.e. do not be afraid to pay a premium. All right. And then number 3 is don't steal the peas. A loan should not be made without a loan repayment schedule or method. All right. So you just shouldn't make a loan without a plan to make a loan repayment. Thank you for watching. If you have a question that you would like an answer to, email us at the email below, and be sure also to like and subscribe and join us weekly for content. Have a great day.